Good morning, good afternoon, and welcome to the Refinitiv webinar, Optimizing Your ESG Investment Strategy to Navigate the Recovery Stage. Before we begin, I would like to cover a few housekeeping items. First, some technical notes. Click on the media player on your screen to enable sound and video and ensure that Flash is enabled on your browser. If the slides get stuck, please refresh your black browser at the bottom of your audience console screen. If you have any technical difficulties during the webcast, please click on the Help widget. It's a yellow question mark. There is a Q&A box on the upper right corner. Please submit your questions to the speakers in this box. We'll try to answer as many questions as we can during the last 5 minutes of the webcast. But in case we run out of time, questions will be answered via email as well. To see additional resources, refer to the window box below the slides deck. And finally, the link to the recorded webcast and a copy of the slide deck, as well as any other resources, will be emailed to you after the conclusion of the event. My name is Elena Filipova. I'm the Global Head of ESG Proposition at Refinitiv, previously the Financial and Risk Business of Thomson Reuters. And I'm also a member of the Technical Expert Group on Sustainable Finance appointed by the European Commission. Refinitiv powers the global financial industry with data, workflow solutions, and expertise. In terms of ESG, Refinitiv has enabled sustainable investment strategies since the early 2000s, and we offer one of the most comprehensive ESG datasets in the industry. In the first quarter of 2020, many markets felt the shocks of the COVID pandemic on the global economy. However, according to Refinitiv Lipper, inflows into ESG funds were resistant to these trends, and the sector saw a robust level of investing, totaling $36 billion. Collectively, ESG investors showed more appetite for risk, which means they basically stuck to their long-term allocation strategies. In the broader fund market, investors sold out of fixed income, held pat on equities, and piled into money markets. ESG displayed a muted version of all three of these trends, going flat in fixed income, tempering inflows into equities, and revisiting money markets after a quarter of negligible flows. ESG has largely withstood the shock of the COVID virus pandemic. But what lessons have we learned from this global crisis, and how to apply those lessons to optimizing ESG investing strategies and navigate the recovery stage? To share insights on this, we're delighted to have Gautam Dhingra and Chris Olson. Gautam, can I start with you and ask you to just quickly introduce yourself, please?
Yes. My name is Gautam Dhingra. I'm the founder of High Point Capital Management based in Chicago. High Point's strategy involves systematic valuation of intangible assets, including ESG factors. It's a value-oriented strategy that we have applied for 20 years, and over that time period, we have been able to beat the benchmarks by almost 3% per year, and ESG has been part of that outperformance. Chris?
I think you summed it up very well, Gautam. Elena?
Great, thank you. Let's flip on to the next slide and look at the 5 areas that you're going to share insights with our audience today. First, we're going to talk about this outperformance that we've seen in the market when it comes to ESG. And more importantly, how to sustain that into the recovery stage and in the future. We're then going to move into the importance and the connection between ESG and quality. Then are ES and G all the same or different? The important topic about fossil fuels, and wrapping up with how to really market your ESG strategy in an effective way. So let me start first with you, Gautam, and move on to the first lesson that you've learned through this crisis.
Great. Thank you, Elena. We are happy to have this opportunity to share 5 insights from our work in ESG over the last few months, few years. While we cannot promise you that all of these insights would be brand new and so original that you haven't thought of some of them before, but we certainly hope that some of what we have to say would at least give you a little bit of a different perspective on a few things than you might have on your own, and we hope that would be helpful. Now, if you look at this slide that's on the next page, it shows some of the recent headlines that we have seen in press, basically saying that ESG has done well in recent quarters, recent years, and also new money is going into this field. We all know that. And if I could refer to the Morningstar article that I refer here that was published on April 3rd, in that article, Morningstar identified 10 ESG index funds, and I'm emphasizing the word index. They identified 10 index funds that are ESG and are represented in Morningstar's large cap blend category. When we investigated to see how those indexes were positioned, what we found was what you see on the next slide here. Here we show the sector allocation of these index funds, and it's quite clear right away that information technology has been overweighted, and it was the case that information technology was overweighted by 10 out of 10 funds or indexes. Energy was underweighted in all 10 of them, and financials happened to be underweighted in most of them. So the question comes up, did that factor of sector weightings influence performance? To test that, we positioned the sector allocation chart side by side with performance of the sector chart that you see in front of you. So the sectors are arrayed in identical sequence, both for the first chart and the second chart. And when you simply visually look at it, it's pretty obvious that the sector exposure of ESG indexes has been in good alignment with how those sectors have performed. And that phenomenon is partly responsible for the outperformance of ESG funds. Now, here we show data for indexes, but I can also tell you that we did the same analysis for the 10 largest socially responsible actively managed funds, and we saw practically the same phenomenon. Virtually all of them were overweighted in technology. Every one of them was underweighted in energy. The only difference we noted between active versus passive ESG funds was actively managed funds were consistently underweight utilities, whereas that wasn't the case quite so to the same extent when we looked at indexes. So when we see these data points, what strikes us is that we know that technology is heavily weighted in growth indexes, and we know that energy and financials are heavily weighted in value indexes. So we come up with the conclusion that by default, ESG investors seem to be overweighted in growth stocks relative to value stocks. And the question we want to ask is, so if this phenomenon of being overweighted in growth has helped ESG investors, what would happen if the value cycle turned around and value started being in favor again? We know that the long-term history shows us that value and growth go in cycles. We do not want to rule out the possibility that value could easily come back in favor. What we would hate to see happen is ESG investors underperform because they do not address the default gravitational pull towards growth stocks. So we want to suggest to our audience, to ESG investors in general, that they consciously and proactively take a look to see the extent to which their portfolios might have growth bias, and if necessary, take corrective action proactively. And the way we want to suggest that people look at this concept, let's go to the next slide. Actually, before we go to the next slide, we actually have a question for the audience, and you might like to hear the answers of others who are on this call also.
That's correct, Gautam. Let me read out aloud the question for the audience. It will be great to get your responses. Are your ESG portfolios biased towards growth or value? It's a multiple choice question with 2 answers. Please select and submit your answer. And I'm going to give you a couple of seconds to get the responses back and look at them. Okay, another couple of seconds. Okay, great. Let's look at the results. So it looks like 2/3, a little less than 2/3 of the audience selected bias towards growth, and about 1/3 selected value.
So you can see that we are kind of all in the same boat in that there is a gravitational pull of ESG investing towards growth. So let's think about changing our perspective. So we all know that we can look at stocks from a value versus growth perspective. The left-hand pie chart simply shows that, and we have assumed that value and growth are roughly 50% each of the stock market universe. On the right-hand side, we have given you a visual depiction of the stock universe classified by those that meet ESG investment is those that meet the criteria, and red that do not. Now, don't worry about the size of these segments. That's arbitrary, and it's going to differ from one ESG investor to the other. But generally speaking, it has been our experience that the percentage of stocks that get excluded from ESG investing is usually a minority portion, and for that reason, the red segment is smaller than the green segment. Now, let's put one of these pie charts on top of the other. When we do that, it's going to divide the whole universe into 4 segments, and that is going to look something like this. The stocks that qualify both from a high ESG perspective and value, those that are high ESG and growth, and then you see the red segments divided into growth and value as well. Just quickly focus briefly on the size here. We have intentionally made the growth segment that is in red, meaning stocks that are growth but do not qualify to be good ESG investment, that segment to be smaller rather than or compared to stocks that are value and low ESG. And the reason we have done that is simply based on the fact that that seems to be the practical reality, in that investors seem to be able to find good ESG stocks in the growth universe better, and it is harder to do it in the value universe. Now, the way to overcome the growth gravitational pull our suggestion would be that we look proactively and with a fine-tooth comb to the top left segment, which is described as value and high ESG. If we do that, and that's what we have been doing at High Point, we are able to come up with stocks that neutralize our growth gravitational towards and give us the value factor exposure that we want at a reasonable level without sacrificing the ESG characteristics of the portfolio. On the next page, we give you an example of a recent stock that we have purchased. The stock is Lowe's Stores, which is a home improvement company that competes with Home Depot in the U.S. If you look at the characteristics of this stock, this is a stock that has perennially been a sort of stepbrother to Home Depot in that it never seems to quite catch up to Home Depot in terms of its performance or valuation. And as a result, it has consistently historically sold cheaper, and that is the case right now. So it is clearly a value stock compared to the market, compared to Home Depot, its biggest competitor. And you see the valuation here. But what's happening at the company is the company has made lots of positive changes. The entire management team is new, doing all the right things. And this happens to be a company that is a really good ESG company. It has consistently improved its performance. The products that it sources are eco-friendly to a greater extent than most others in the industry. Its supply chain is constantly monitored to make sure that they are complying with the social standards that are expected from good suppliers. The company's board of directors is very independent. 12 out of 13 directors are independent. And the company is constantly making changes, in particular since the new CEO came on board in summer of 2018. So here's a stock that qualifies very well from an ESG perspective. And you can see that Refinitiv ratings on environmental, social, governance, and controversies are all very positive for this stock. So this is one example of how by proactively searching for value stocks that meet our criteria on ESG, we can do a better job of ensuring that we are not overburdened by the gravitational pull of growth investing when it comes to ESG. So that's kind of the first lesson we wanted to point out, that this recent crisis has pointed out very clearly to us and to everybody else about the growth orientation of ESG investing. And we think it behooves us to look into it carefully, understand the biases our portfolios might have unintentionally, and proactively take a stance to either neutralize it if that's what's needed, or to overweight or value if that's needed. But certainly if you think growth is the right place to be, you can maintain the current positioning. But the main point is let's not rest on the laurels of recent performance. Let's make sure that we can keep it going. And one way to do that is to make sure we understand the value versus growth bias in our ESG portfolios.
Great. Thank you so much, Gautam, for the insights with the first lesson learned. Chris, shall we move over to you and maybe talk through the links between ESG and quality integration?
Certainly. Before going into the slide, I think it's interesting to note the evolution of ESG data that we've seen over the years. So for those of us that have been in this business for quite a while looking at ESG, it's gone from a period where it was really a qualitative look at things. There wasn't much data to back it up. Certainly, even if you went back 5 years or even less, it was hard to get enough data to do much statistical analysis. Fortunately, like with everything, we're seeing a lot more data, and particularly with Refinitiv data, we've seen a lot more data. It's more robust. And we're starting to get to the point where we can do some analyses that can hopefully draw some reasonable conclusions. And so if we do that, one of the first questions that we wanted to ask is, do you incur a performance penalty by looking at high ESG companies? So we all know, and we've talked to clients before, that there's a wide range of perspectives on ESG. And there are those that want social impact, that understand and really focus on ESG. You'll have other clients that are more skeptical, feel that alpha is by far the most important. And there'll be a belief that by looking at high ESG companies, you sacrifice performance, basically that you're paying to do good. So I think that's one of the first questions that we wanted to answer. We now have 12 years worth of data. We can start to get a decent insight into things. So if we took a look over the past 12 years and we looked at the performance of high ESG companies, simply those in the S&P that rank above median relative to low ESG companies, those that rank below, and take a look at the performance over time, we can see actually high ESG comes out slightly ahead. Now, that's not statistically significant, but I think what it does do is point out to the naysayers of ESG that you're not going to automatically incur a penalty, right? You're not going to start from behind by having an ESG portfolio. And I think we think that that's very important. The other thing that's interesting is on the right-hand side, we take a look at the volatility of high versus low ESG. And that's where we start to see some things that are statistically significant. Volatility is lower on high ESG. And I guess that would make sense. If you have companies that are paying attention to all the environmental, social, and governance concerns, you'd think that they'd also pay attention to their business much more, and you generally end up with a higher quality portfolio. Now, the higher quality portfolio aspect, I think, is very interesting, and we found that when we start to run some of the data. So if we take a look at the excess return of the high ESG portfolio, we do in fact see that it correlates well with the quality factor. So a correlation of 0.42 and a meaningful T-stat over 5. And again, that's really important because quality obviously is going to factor into the overall analysis of the stocks that we're taking a look at. If we take a look at the volatility aspect, it certainly comes into favor and certainly plays out well. And we look at things like the Great Financial Crisis, which we have the returns up, that the high ESG portfolio, as one would expect if you have generally lower volatility and more of a quality bias, we can take a look at the high ESG portfolio dropping much less in 2008 relative to the low ESG portfolio. Now, obviously, when things rebound, you won't have quite that catch-up that the low ESG portfolio would have, but cumulatively, you're looking at a much better return over time. Now, when we take a look at ESG, we think it's important that we don't just look at it alone. We think that we have to incorporate it holistically within a larger framework. So it's not going to give you everything, but it's going to give you some really important insights into the companies that you look at. So we look at it in a broader framework, what we call franchise quality, where we look at two aspects: how good the business is and how well it's being managed. And it's important, obviously, to take into account underlying business dynamics, which the left-hand side of our analysis looks at, and the right-hand side where we start to see the ESG come into play. Now, what we'll do is we'll score these companies from low 1, high 5. We'll sum them up, and they'll go into a regression analysis. This will be one factor that help us determine what an overall value for the company would be, for the stock would be. If we take a look at the E, S, and G aspects to this, I think one of the important things that we do is we don't just take the scores straight away, the top line scores for E, S, and G. What we do is we make certain that we dig down deeper into the scores to see what's driving them. For many companies, certain aspects aren't all that important. So if you looked at environmental, it's obviously much more important for an energy company than it is for a financial company. We'll also want to take a look at the change that we're seeing within ES&G. So I think quite often a lot of people will say, okay, we're just going to take a look at high ESG scores, and that's what we're going to build our portfolio around. And that's fine. You can find opportunities there. But quite often what we found is, just like any turnaround in a company on its business operations, you'll also find that you'll see ESG turnarounds as well. And quite often they go hand in hand. So what we found is often we'd be looking at companies, there were low ESG scores, but we could understand why they were low, and that may have been for good reasons or not. Or you might see companies start to change, and we think that the change, certainly the positive change in ESG, is what our clients are looking for. And once you see that turnaround, often means that the company's getting its act together. And just like a business turnaround, the ESG turnaround will lead into higher stock valuations. So just summing this up, we found that ESG does not incur performance penalty. And even though it doesn't straight out give you outperformance, we do see the lower volatility, the importance that it ties into with regard to the quality of companies, that it's an essential factor to look at, that you can't look at it alone, but it has to be incorporated. And why wouldn't you incorporate it? Certainly when you get much more insight into these companies, it can be some great data to help build out the view of your stocks and your stock research. Gautam?
Yeah, Chris, if I could add one more point. So one reason why we wanted to bring up the quality issue, and I'm going to go back to the slide that Chris was on, is those of you who are relatively new to ESG investing, I don't want you to feel like that you have to somehow start over or bring in something new and figure out a totally new way of doing things. ESG can fit, in my opinion, virtually every stock selection framework that people already have. It's simply additional useful information. The way we have incorporated it through the quality dimension, and we are convinced that quality is a critical factor when it comes to performance. We are also convinced that ESG helps us measure quality. So that's how we have chosen to do it. Even if quality is not specifically a part of your stock selection framework, I'm sure risk is. Without risk evaluation, there is no investing. So I would suggest that if you wanted to bring in ESG holistically, and risk is obviously a dimension that you do think of, that would be another way for you to bring in ESG holistically into the picture. So don't feel like you have to start over from scratch when it comes to ESG. ESG fits virtually every stock selection framework that people have already used for decades. Let's
Great point, Gautam. Great point, Gautam. Maybe I was just going to move us to lesson number 3 of today's session. We talk about ESG, 3 simple words, environmental, social, and governance. But at the same time, they encompass so many diverse and different issues and topics. Are they all the same? Is it fair really to try to bring them all under the same umbrella? What do you think about it, and what's your recommendation to the audience?
Right. So E, S, and G are often mentioned in the same breath. And what we want to mention, and it is not something that I think would surprise you, is that aggregating the E, S, and G scores risks diluting the information. If I could give you an analogy, if somebody described a group of people to you, and in that group there were 10 people who were all 6 foot 6 inches or taller, and there were another 10 people that were all 5 foot 5 inches or shorter, and somebody asks you to describe the group, if you were to say that, the group is about average with 6 foot height, that really wouldn't start to describe the nature of the group because we are missing the point that 10 people are very tall and 10 people are very short. That's how I feel about ESG being aggregated sometimes. There's a loss of information when you do that. First, let me describe some data that you may find somewhat interesting, but I'll come back to this point about the need to separate E, S, and G. We decided to take a look at new economy stocks and old economy stocks, and we decided to define new economy stocks differently than how somebody might identify them. We looked through the financial statements, and we looked to see which companies were spending more money on R&D and software and classifying it as a separate line item, and those that were spending less. And the companies in the first category are the ones that we call new economy stocks, and those that were spending less, we call them the old economy stocks. We then checked the ESG characteristics of these two categories of stocks, and quite interestingly, we found that new economy stocks seem to be better when it comes to ESG characteristics from an environmental perspective and social perspective. And that finding is reasonably consistent with our earlier comment that ESG investors are able to find good ESG stocks in the technology sector easier. But what we also found was we did not find governance of these new economy stocks to be any better, and in some cases it was worse than that of old economy stocks. And what has happened is some of the large technology stocks that find their way into ESG portfolios, they still have dual class of shares, so that on paper at least, some investors or some shareholders do not get treated equally. So we don't find governance to be of the same caliber in new economy stocks compared to old economy stocks. And so what we have decided to do is that we have said aggregate data, whether it's at ESG total score or ESG category score, is insufficient to get full value out of ESG. The only way to get full value out of ESG is to actually look at the raw data that firms like Refinitiv provide. And let me give you a real-life example of what happened with us. This was just a short time ago. We had identified a company called Cree, C-R-E-E. This company makes semiconductors that go into electric vehicles, which make it possible to charge electric vehicles in a shorter amount of time. And obviously, when you are able to do that, you are likely to increase the adoption rate of electric vehicles. So at one point, the company met our valuation criteria, franchise quality criteria, and from what our view was, we expected it to be a good ESG steward as well. But we looked at this company's ESG scores in Refinitiv, and it was below average. So just with a couple of clicks of a button, we clicked on the detailed raw data that we have from Refinitiv and realized that a couple of things were driving that below average score. We, armed with that data, we picked up the phone, we called the company and talked with the treasurer, and our question was very specific. One of the questions we asked was, why is it that Cree is not meeting the OSHA certification standard 180001. It's an OSHA worker safety standard that companies ideally should be meeting. Now, there's no way we would have known that data if we didn't have access to the raw data at the click of a button. So when we had the conversation with the company, we learned that all of the requirements had been met, the data had been submitted to the regulators, and the certification requirements had been completed so that the next time ESG data providers collected the data, they were going to see that there was no deficiency from that perspective. A second question that we asked was about the product quality recall. Once again, a click of a button on the Refinitiv data told us that the quality recall issue in the LED bulb division was an issue. And we learned from the treasurer that not only the quality recall issue had been fixed, but also that the firm had put up the LED business up for sale to focus strictly on the electrical vehicle business. So here was a case where we clearly understood that the ESG scores were going to improve the next time they were published. So it sort of tells you two things. One is looking at a summary or category score is not enough. You have to get your hand dirty. There's no shortcut to success. You have to get to the raw data. But it also tells you that it is, with the click of a button, you're able to get a handle on that raw data that you need to be a more informed investor. So ESG data, we find it to be a useful tool at the raw company level data. But then we have to exercise our own judgment and do our own due diligence to get the best out of it. So the main thing I would suggest to you here is that learning from our experience, finding value in ESG by looking at aggregate category scores is likely not to be a rewarding experience, certainly not a consistent one. Our suggestion would be to use the raw data and do the due diligence, use ESG as a tool rather than an end in itself, and we think it would help your alpha generation process. So that's our third thought of the day.
Excellent. And if I can summarize, I think that you describe it excellent. ESG data can help uncover risks and opportunities that are not easily understood and factored in valuation, but it doesn't replace the due diligence that financial professionals have to do. Great point there, Gautam. Thank you. Moving on to the fourth lesson. Let's go a little bit deeper into an industry and look into fossil fuels. Are all fossil fuels the same when it comes to an ESG lens, and none have a place in ESG products and strategies, or what do you think?
Elena, thank you. So this topic of fossil fuels is a lightning rod for ESG investors and certainly for ESG activists. And we've all seen protests on college campuses and elsewhere where people want to talk about divesting all fossil fuels. So the view that we would express to you is not all fossil fuels are equal. And even though ESG investors intuitively understand it, but sometimes in the spirit of activism, it all gets lumped together. I think there's a smarter strategy that can achieve the long-term objective of making our climate better and other environmental issues if we are willing to have a discussion about the sequence in which fossil fuels need to go out. The sequence in which they go out, I think you can see that trend already. Coal is practically on its way out. And what I would like to suggest to our audience is that between oil and gas, the sequence is going to be that oil is going to go out first and gas is going to go out second. To kind of make that point a little bit more clearly, let's look at this slide on that's in front of you. This one is a slide that if you haven't seen it before, sooner or later somebody is going to show it to you because it shows from a Lazard study that now renewables are competitive relative to conventional energy in terms of how much it costs to generate a megawatt of electricity. And occasionally this slide gets misused by some people saying that that means we are ready for renewables to basically take over and we should be moving towards all renewables as soon as possible. But there are some real practical issues that get in the way. And these issues are related. They're not all separate points, but they're listed on this slide. Storage, reliability, and transmission on demand. Renewables are not where they need to be able to achieve these three objectives at this point. I'll relate to you a conversation with a senior executive at a utility who was asked, can you replace 90% of your conventional energy with renewables? And his answer was, yes, absolutely I can. And the next question was, then why don't you? And his answer was, because I would still have to maintain 90% redundancy in conventional energy in order to overcome the objections that you see on these slides. So from a practical perspective, the utility executive was saying that we cannot get there. So we need a transition period. And that transition, we believe, is going to happen by oil going out slowly first from our lives, leaving natural gas as the last fossil fuel, and over a longer period of time, the gas will go out. I won't get into all the details of why we think oil is out, but some of what you saw in the COVID crisis basically shows you why oil can be on the ropes for a few different reasons, whether they are demand reasons or because of game theory reasons, stranded asset problems. There are many reasons why we think oil is going to struggle for the foreseeable future. And once we acknowledge what's on this sheet, which is natural gas is a cleaner energy source than oil, then it's not difficult to see how natural gas can be used as a bridge that takes oil out first before it itself goes out. So even though longer term, we can understand the point that fossil fuels can and should be replaced by renewables, but I think a smarter strategy would be to think about the sequence and how that might play out. And whether you are alpha generation-oriented investors or ESG-oriented investors, we believe it makes sense to think about the sequencing, and you might actually be able to help the process if you truly want to achieve climate change success by realizing that oil and transportation is the bigger issue than gas and power generation.
Gautam, maybe I'll... Great. I think I'll throw in a question that has just come in related to this point on lesson number 4. One of our audiences has asked, why isn't nuclear included in the energy analysis?
So I acknowledge the point that nuclear belongs here, and I can have my personal view on it. Everybody else seems to have their own view on it. I'll share my personal view with you. I actually think that nuclear has a solid case to be made as an environmental issues free, because the storage issue, which is obviously the one that keeps people from using nuclear, is the fear factor. So my personal view is that nuclear belongs here, just the way natural gas belongs here. We didn't put it in here because it just becomes a separate discussion, because a non-economic issue of how to store and how to reduce the risk associated with that storage. And people just get wind up in that emotional discussion so that the economic discussion falls away. So until you're able to overcome the emotional hurdle, there's not a real point in discussing economics. But I would agree with this audience who posed the question that nuclear absolutely belongs in there and can be part of the solution.
Thank you. Let's move on to the second poll question. It reads, do your ESG portfolios expressly exclude fossil fuel companies? Yes, is the first option to answer. The second, depends, but I have the ability to exclude them. And the third option is no. Please choose your answer and click submit. We'll have 10-20 seconds to gather answers. Okay, another 5 seconds. And let's look at the question results. So almost a quarter have said yes. 37% depends, but I have the ability to exclude them. And close to 39% have answered no. I think that illustrates the diversity in different ESG strategies.
Right.
Gautam, any additional comments?
I'm actually glad to see that 3/4 of the investors are showing some flexibility. I do think having some flexibility is important.
Fully agree. That's great result. Let's move on to the fifth lesson. How shall investors communicate to their stakeholders, to their customers on their ESG strategies? Let's talk a little bit about marketing.
So from a marketing perspective, when we have had discussions with our prospective clients, it used to be we would simply try to point out that there is not likely to be a performance penalty and that we can do social good by doing high ESG investing. That used to be the two main parts of the marketing message. Over time, as we have done more research, seen other people's research, we're actually reasonably comfortable adding one more value-added potential to show clients, and that is the higher quality and lower volatility of ESG strategies, we believe is likely to sustain in the future too. It is not just a phenomenon of what has happened in the past. So the value-added proposition of ESG investing now, from our perspective, would be threefold. No performance penalty, we can do social good, and three, we can likely give you a higher quality, lower volatility portfolio. Because we do believe that this is something we can sustain in the future. So that's how we are positioning our message because we believe in it. And we're just suggesting that as something for consideration for the audience. We certainly don't recommend focusing on outperformance, historical outperformance, as a leg to stand on, because we don't know if that will necessarily be sustained. So we don't think that is the way to show it to our prospective clients. A second point that we make is with all the data that has now become available, it is not difficult to show how your portfolio is making a positive difference compared to the benchmark. So I would suggest, once again, getting hold of the raw data, not the aggregate ESG scores. Our audience does not appreciate the nuances of environmental score of 70 versus 80 as to what that means. Show them how much lower carbon dioxide is going into the environment in your portfolio compared to the benchmark. And lastly, we have to kind of find our original angle. High Point's original angle is valuation of intangibles, including ESG factors, into the franchise quality framework. And we would suggest finding your own original differentiation, because that is the only way to get noticed. Elena, shall we summarize and then go to...
Maybe, Gautam, if I may, I wanted to ask the audience another poll question.
Okay.
Before we summarize the key takeaways.
Yeah.
So to get a better sense of the type of requests, mandates, and demand that you receive from customers, are your clients more interested in the E, the S, or the G, or all three of them? Can you please select one of the four options and click submit? Great. Let's take a look at the answers. A little less than half have selected E only, 4% S, close to 14 G, and 34% all three of them. I think that that's what we're seeing around the world as well, to be the highest customer demand currently. And in the last couple of years, the focus has really been a lot around understanding the actual material impact that different environmental issues and challenges have on businesses and valuations currently and in the future. Very little understanding and clearly demand when it comes to S, and a lot of talk in the last couple of months of this shifting in light of the COVID-19 crisis. It's interesting that G is only 14%, at least from my perspective. What we're hearing and seeing is that G is the foundational layer that underpins the effectiveness that companies have in managing their environmental and social risks as well as opportunities. And 34%, all three equally. I think that here the one comment to add in brackets is where material, and that's a very important element to understanding and integrating ESG into investment processes and workflows. Gautam, great. Any reflections on the last poll? And let's move on to summarizing the 5 lessons and the key takeaways.
I actually find the poll to be very insightful. In light of the fact that we have 7 minutes, I do want to leave time for audience questions. So let me just summarize the last slide, which is key takeaways, very quickly, so that we can then ask the audience for any additional questions. So the 5 things that we wanted to share with you. Number 1, we think it makes sense to look at the value universe very carefully and make sure that your value versus growth bet is where you want it to be if you want to consistently outperform. And it is possible to find good value ESG stocks. Secondly, we think we have become more comfortable with quality being a sustainable characteristics of ESG, and that is how we think you can bring in ESG holistically if you haven't done it already. Thirdly, we talked about the fact that E, S, and G, look at it separately, and if possible, actually go to the raw stores, get your hands dirty, because that is the only way to add value. There are no shortcuts to success in ESG investing by looking at summary data. Fourth, we suggested that looking at oil and gas differently might make some sense, because we do sense there an opportunity to get oil out of the picture over the next decade, 2 decades, 3 decades quicker than we can with gas, and that would have a beneficial impact on the climate. And lastly, we had a couple of thoughts on the marketing side. But let me turn it back to you to see if we can address any questions that the audience might have.
Thank you, Gautam. And I will move on to the next slide and try to respond to one of the questions that came in. What's very important, we believe, is to know the direction of travel first, to clearly define your objective, your strategies when integrating ESG, and then find the right information sources, the right ratings to empower that strategy. One of the questions that came through, and thanks to everyone for submitting questions so far. We have a great line of questions. We'll try to go and answer as many of them as possible. And do submit anything else that you want to ask our speakers today. One of the questions was around ESG data and scores, and are they really correct? Especially in today's world of fake news, they might not reflect the real status of companies. So how to navigate that area? And I guess to build on that question more, there is also a lot of difference in ESG ratings currently available in the market, but that is quite understandable, considering that we already spoke about the diversity and variety of issues covered within the ESG umbrella. And ESG ratings have a different lens on the issues. They may look at performance, absolute or relative, of any one asset or company, with a focus on environmental performance, or more focus on social performance, or more focus on governance performance, so that degree of weight or materiality assigned to different factors varies. The ratings might be assessing impact and products and services that companies are offering to respond to different environmental and social challenges. So there are different ways to look at the broader sustainability issue and assessing sustainability of companies. So my advice to all of you would be to know and clearly define your objective and inform yourself about the different ratings available in the market and what they offer, to make sure that what you take indeed aligns with what you're aiming to deliver. Let's move on to the next question. I will ask one of you to answer. So it says, most of the discussion today applies to listed active equity investing. How can ESG and sustainable investing be applied to asset allocation and top-down strategies?
Elena, I wish I had a better answer to that than the questioner would like, because our focus is on equities only at our business. We have not addressed this issue, so regretfully I must pass on this question.
Okay, thank you. Let's move on to the next question. How ESG factors reduce the asset volatility in times like this?
Can you repeat?
Can I jump in on this one, Gautam?
Yeah, go ahead. Okay,
so we're taking a look at asset volatility, and we think about what happened in the GFC and most recently with the pandemic. Companies that have the most question marks generally are the ones that you see get hit the most. So if you go into the GFC or you go into the global pandemic, you get big questions about the outlook for growth and how it's going to impact a company's earnings. So if the economic cycle changes to the downside, certain companies will get hit more, so there are bigger question marks. We'd also look at balance sheets as well. So if you have a higher debt level, you go into a period of intense market volatility. Certainly the economy's going down. It's more questionable whether or not you're going to be able to repay your debt and if you have to refinance. And I think I'd look at it at ESG as the same. So there are a number of questions for every company in ES and G. So if you have a company that's had environmental issues before, is not putting out the right products, you're going to have more questions about the sustainability of that. And the more questions in volatile times, the more likely a stock's going to get hit. Because in tough times, you retreat and you figure if it's a question mark, the answer is more likely negative. On the S side of things, if you've had strikes or if you've had issues, social issues within your company, or to hit your reputation or your relationship with your clients, that will come to the fore because people are reducing risk. There's a question mark on that. They will not give you the benefit of the doubt. And the same with G. If they think they're not going to be treated well, why would you hold a company in a down market when maybe they have to raise capital at your expense? So for us, it gives a more in-depth picture of what the quality of the companies are and where the question marks are. And the fewer question marks, the less volatility you'd see in a down market. Gautam, do you have anything to add to that?
No, that's good.
Great. A final question, and apologies, we'll probably run a minute or two over, and I ask you to please give short and crisp answers. How do firms get started on ESG? There are a lot of criteria, data sources, which one can pick up first. Seems there is lack of standards in implementation. Can you provide your guidance, as I guess many users are starting the journey now?
Correct. So when we looked at the data sources, we felt that governance was an issue that should be applied to all companies equally. And when it came to the environment and social, we understood that industries differed from one to the other. So we couldn't easily compare an energy company to technology company and say that the technology company has better environmental less CO2 emissions, and therefore we're going to pick the technology company over energy company. So we decided to make a distinction that within the energy space, we wanted to know which companies were doing better than others, which companies were improving their practices when it came to the environment. So from E and S perspective, our philosophy was find the companies that are progressive and getting better. So Refinitiv methodology was to look at E and S from a peer group perspective and governance from a nationwide perspective. That was consistent with our philosophy, so we picked the database on that. And I think that goes to Elena's point. Figure out what your philosophy is about E, S, and G, and that might help you select the right data source.
Great. Thank you so much. Let's wrap up. To request the free trial of Refinitiv ESG data, click on the window box on your left. You will see a survey popping up on your screen once the webinar is over. Please share your feedback so that we can keep improving and continue presenting to you relevant and actionable information and insights. And special thanks to our speakers. Gautam, Chris, your insights were excellent. Thank you so much for sharing them with us. And thank you to our audience for the engagement, for the time and the great questions. There are many of them, and we promise to come back to you with email responses. Goodbye, everyone.
Thank you.
Thanks.